Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And before I jump into today's episode, just like to remind people, if you have any questions, you can send them to me at questions@investopoly.com.au. Try and keep the questions relatively general. I can't give you obviously personal advice. I don't know your circumstances, but what I wanted to do is create more interactivity with the podcast. And if you've got questions on, certain sort of principles or matters or investment options or these sorts of things or anything that I've spoken about, it's very likely that other people have the same questions and that's what I'd like to answer. I've received a whole bunch of questions. I'll answer a few at the end of today's episode, but don't stress if I don't answer your question. I'm going to get to them and I might even just do an episode just on questions if that suits everyone. So anyway, let's jump into today's episode. And today's episode is about how much super should you have by the time you get to retirement. You might realize that I am a relatively regular guest on the Australians podcast called The Money Puzzle, which is hosted by the wealth editor James Kirby, and I also write some articles for that section of the paper as well from time to time. Anyway, recently he delved into the topic of, how much super should you have? And I thought it's a really interesting topic, obviously something that's very relevant to almost every Australian, and I couldn't resist the temptation to jump in and kind of share my insights and analysis. So let's start with the topic of life expectancy, because James Kirby interviewed a gentleman by the name of Ashley Owen recently, and he was discussing life expectancy tables, which are these statistical tables produced by the Australian Bureau of Statistics that sets out the median lifespan for males and females born in certain years. And so hopefully that sort of, the financial planning industry and the insurance industry and so forth use that as a guide with respect to doing planning and setting premiums and all those sorts of things. Anyway, I thought he made really three interesting comments with respect to life expectancy tables. And, some of them are obvious, although they didn't really dawn on me until I was sort of listening to what he was saying. And he's written an article about this. Of course, I've included the link in the blog on the website to that article if you want to learn more. But anyway, his three insights were, firstly, it's a median value, right? So 50% of people actually live longer than that value. So if I look at my life expectancy tables and it says 82, that's fine, but 50% of people my age lived longer than 82. So there's a risk, longevity risk that, I outlive my money. Oh, and also pointed out a really interesting trend that life expectancy tends to increase by 2 to 3 decades over your entire life. So for example, when I was born in 1974, it's a long time ago, 1974, my life expectancy would have been X. If I look at the tables today, what is the life expectancy for a male born in 1974? That life expectancy is going to be a lot higher, a lot longer, a lot older in age than what it was in 1974. So let me explain this probably better using my father as an example. So when he was born, his life expectancy was 66 years. Today, his life expectancy is 82 years. So an increase by a quarter, 24% over that period of time. And I imagine this life expectancy has improved largely due to, preventative medicine, improved medical treatments, better health education, these sorts of things. And then if we overlay, the potential impact of technology like AI and how it might be used with medical treatment going forward, how it's being used with medical treatment today and how it will be used even more in the future, it's intriguing to think about, how life expectancy might change. So, for someone, say, in their 30s today, chances are they're probably going to live to 100, I would have thought. I'm no expert in this area, but just looking at that data. And then finally, of course, personal factors such as health choices, fitness levels, lifestyle, diet, genetics, all those things play a role in life expectancy as well. And that's what we also need to really think about. Now, of course, fit and healthy people can get hit by a bus. So, of course, there's going to be random events. But when we're doing financial planning, what we should be doing is almost plan for the worst, hope for the best. Now, living a long and healthy life isn't worst case scenario, but it is from a financial planning perspective, right? So we obviously don't want to run out of money. And when it comes to financial planning, it's very important then to think about life expectancy, because we might end up being in retirement for many, many years than we might otherwise expect. Now, there's a lot of online calculators that you can sort of Google and that'll help you work out, how much super do you need, how long will your super last, all those sorts of things. Look, it's really important to understand the assumptions that are used in those calculators, particularly living expense assumptions. You really want to use a calculator that allows you to put in your actual living or target living expenses. If not, it'll just use some index that's probably, a very low standard of living, which might not be. Probably no one wants to live with that sort of standard of living. And then you want to think about return assumptions and those sorts of things. But ultimately, all these calculators, or at least most of these calculators, assume that you're going to run your wealth, your portfolio down to zero, which is fine. There's a book, in fact, called Die with Zero, which I've referenced previously. The thesis is we work hard for our money. We may as well enjoy it. What's the point of, leaving it in the bank when we pass away? Now, of course, if we've got beneficiaries that we want to look after, that's the point. But anyway, it's kind of an interesting concept to think about. But if we're really worried about longevity risk, what will happen with medical treatment over the next couple of decades and what impact will that have to my life expectancy? To a great extent, that's very hard to ascertain today. There's a risk there that, I'll end up living a lot longer than I might expect that's reasonable today to expect. And so the one way to accommodate that risk is to aim for having a perpetual portfolio. So a perpetual portfolio is one where the capital of that portfolio is preserved and retirement is funded from perhaps the growth in income that comes off that portfolio. But even in real terms, after accounting for inflation, the capital remains intact. And in that situation where you're not eating into your investment capital, mathematically, you could live forever, of course, because it's a perpetual portfolio. So that's quite distinct to saying, okay, I've got $1 million. I'm going to spend that over the next 20 years until in 20 years' time I have zero in the portfolio. The other thing I recently talked about was a perpetual portfolio guards against things like an unexpected rise in expenses. Like recently, obviously the last 4 years, we've had a lot of CPI, a lot of inflation, and also unforeseen large expenses, maybe medical expenses or something like that. If you're not eating into your capital, at least it's preserved for those sorts of events. It's going to insulate you from those changes that might be unexpected. So I want to talk about how could you achieve a perpetual portfolio. And then what I'd like to do is just share and talk to a couple of different scenarios of how that might play out in a kind of real life scenario. So to achieve a perpetual portfolio, it's either got to be one or two things. Either you've got to have a huge amount of wealth and therefore you can just invest that really conservatively, let's say term deposits, to the extent that it's going to deliver enough interest income to pay for living expenses and offset the impact of inflation. So you're not spending all of the interest, that you've got 2.5%, say if that's the long-term inflation, 2.5% to reinvest in that term deposit. So in real terms, you're preserving your capital. That's possible. It's very conservative and very arguably inefficient. And I don't think most people would fit into that basket. The second option is to try and aim to achieve much higher returns, right? Because typically, and I've spoken about this previously on another episode where I talked about or put forth an argument, if you're in your 30s, why would you invest any of your super in bonds? Put it all in equities. You've got a long time horizon. Kind of the same here with a perpetual portfolio. The aim is to achieve the highest return over the next 10, 20, 30 years. Long term, you hope retirement's going to last, going to have an enjoyable retirement for a long period of time. So since we know that equities will deliver the highest return over the very long periods of time, why would we invest then any assets in defensive assets like cash, bonds, infrastructure, and so forth? We know, of course, they've got lower volatility, and that's the technical argument to why we would want to include them in a portfolio. But if we're not worried about volatility, then why would we invest in them? Wouldn't we be better off aiming to achieve, let's say, a 7% long-term return if we're then only spending 3% of that money, or 4%, leaving 3 or 4% left over to protect ourselves against inflation? And by taking or by having a higher allocation to growth assets and therefore achieving higher long-term returns, that helps us achieve a perpetual portfolio. Now that's all well and good, but then how are we going to deal with the volatility? Well, the argument to deal with the volatility is to have 2 to 3 years worth of living expenses in cash. That way, if the market crashes, and it takes a couple of years to recover, that's fine. You can ride it out. You you can eat into your cash and spend your cash. You don't have to sell any investments. Now, would all sectors and markets be down for 2 years? That's probably unlikely. Most corrections recover a lot quicker than 2 years. Probably the most recent exception to that might be the GFC. That took a couple of years to recover. But again, not all markets behave that way. So, emerging markets versus developed markets versus the US or Australia, there's different markets that will behave differently at different times. Doesn't matter. They don't have to. You've got enough cash. If you've got 3 years of living expenses in cash, you don't really need to worry about volatility. The only thing you need to worry about is looking at your balance every day and worrying about, if it drops or rises. But you should stop doing that if that's really going to upset you. From a practical, technical perspective, if we have enough cash to ride through the volatility, then having higher volatility doesn't really matter. So in summary, the best way to achieve a perpetual portfolio is to, invest as much as you can in growth assets and then have whatever you need to feel comfortable in cash to fund living expenses in case those growth assets experience a lot of volatility, and therefore you won't be forced into a situation where you need to sell them in a market that doesn't suit selling those investments. Okay, so as I said, I wanted to go through a couple of scenarios with you to demonstrate how this would work on a practical level. And it's always a bit hard to, explain charts in a podcast. So what I might encourage you to do is go and have a look at the blog on the website, because there's a couple of graphs or charts that I have there that, that you might spend a little bit of time digesting. But I think, a picture tells 1,000 words, of course. So what I wanted to work out is really how much super do you need so that you can spend $120,000 a year on living expenses in perpetuity, adjusted for inflation, of course. So let's assume inflation's 2.5% a year. So each year, it's going to cost 2.5% more, of course. And I picked 120,000 because, used to be 4 years ago, 100,000 was a pretty comfortable, in fact, a very comfortable standard of living for retirement. But of course, we've had, CPI over that time. So let's adjust it up to 120. So it's really the old fashioned $100,000 a year. And I wanted to make sure that we had the same amount invested in super at the beginning, at the end, in real terms, right? So that is a perpetual portfolio. We're not eating into the capital in real terms. And what I worked out that if you needed, in fact, $2.75 million. And if you had $2.75 million, you could in fact achieve that. It's $120,000 in perpetuity. You don't need it into the balance. And say you start at 60, by the time you get to 100, the balance of your super will be 9.3 million, which is really $3 million in today's dollars. So circa what it was when it began. And what I've assumed in these projections is that we always maintain 3 years of living expenses in cash. Now remember, the 3 years of living expenses at the beginning of these projections is 3 times 120, so 360. But of course, inflation continues to increase over that period of time. Living expenses get to 250 in around about 20 years' time or something like that. So in that situation, we would have 750,000 in cash. So I've assumed 3 years of living expenses in cash earning 7%, and the rest of the asset base is invested in growth assets, and I've assumed 7%. Now, growth assets over the last 40 years have generated north of 10% per annum, but I've just been conservative with my assumptions, and at least that allows me to deal with, any potential volatilities and what impact that might have on a straight line projection model. So that's the answer. If you want $120,000 a year to spend and you never want to eat into your investment capital, you need to start with something around $2.75 million. So the problem is most people aren't going to achieve that with super alone. So what can you do then if you work out, which you can do today? There's plenty of calculators online to work out, well, what will my super balance be by the time I get to 60, which might be your retirement age, 67, whatever it is. But what will that starting balance be? And if you jump online and use one of those calculators, and it's not $2.7 million, and that's obviously in today's dollars, $2.7 million. So whatever that is in future dollars, I don't know. It depends on, how far away you are from retirement. But if you're not going to get there, then you need to do something else. So that is invest in other assets. So the second scenario I considered was we had super and an investment property, just one investment property. And what I assumed is let's use super to fund the first 15 years of retirement. And then after 15 years, what we'll do is we'll go and sell the investment property, put a little bit more into super through making non-concessional contributions, and invest the rest outside of super, because we've got limitations on how much we can get into super. But at least that will replenish the super balance and give me, a large amount of liquid assets in order to continue to fund retirement. And in this scenario, scenario, I assume we had a starting super balance of 1.6 million and an investment property that was worth $1.5 million with an $800,000 loan with $300,000 in the offset account. So in this scenario, this person's 60, maybe they bought the property when they were in their 50s, and over that time, they've put a little bit of money, 300,000 into the offset account. So that's kind of the scenario that I'm sort of thinking about. And so you'll again see the chart on the blog on the website. But in this situation, it's not a perfect perpetual portfolio, but it will give them more money than they'll probably ever need. The portfolio does start to run down when the client's in their 90s, and it'll probably run out, when they're 120 or something like that. But that's probably more than enough money than they'll ever need. And the reason it runs down is while they've got the investment property, because they're enjoying compounding capital growth, when we look at the capital growth in the property and the earnings off the super, it's more than their living expenses. So the net portfolio is increasing in value. Whereas once they sell the investment property, for a few years, the investment returns are higher. But as they eat into that capital base, the investment returns start to become lower than the living expense amount. And that's why we see that portfolio come off a little bit. I mean, one of the assumptions I've made is that they're spending $120,000 indexed to inflation perpetually. But the reality is that, we might spend that in, the first 10 or 20 years of retirement, but maybe when we're 100, our lifestyle's probably not going to cost $120,000 to live. So arguably, I've been a little bit bullish on the living expense numbers. And so perhaps that second scenario is actually will end up being a perpetual portfolio. But the key learning here is the property has underpinned super, right? The property's played a really important role in that when my super balance starts to become relatively low, I've got an asset that I can sell to replenish super, to put a lot of money in the bank so that I don't have to worry about retirement. And secondly, by using super first, it allows me to hang on to that property for longer. And we know that because of compounding capital growth, if you can hang on to a good quality investment grade asset for another 10 years or maybe another 20 years, it's going to make a big difference from a net equity position. Okay, so to wrap it up, what do you need to do? Okay, well, the first thing you need to do is think about, what is your goal? How are you going to mitigate longevity risk? How long are you going to live for? Do you want to aim for a perpetual portfolio? Are you happy just to run the portfolio down to zero at some point? Do you want to die with zero? What is your strategy? Then secondly, depending on that approach, you need to then work out, how much super will you have by the time you get to retirement in today's dollars? And what's the gap? Is that going to be north of $2.75 million? And therefore you've got a $120,000 lifestyle for the rest of your life? If not, and maybe your goal is to spend less or more, it depends, you've got to adjust it, of course. If not, what other assets are you going to invest in between now and when you begin retirement so that you can mitigate that risk like I've talked about in that second scenario? Okay, so that's today's episode. Let's get into some questions. As I said at the beginning, I invite questions. You can send them to me at questions@investopoly.com.au. I just opened the file. I didn't realize how many questions we've received. Again, if you can keep them pretty general, that'd be great. I will get through them. I will aim to try and get through them all, even if it means I prepare a bit of a Q&A episode, which I might do in the near future. Anyway, let's get into some, and I might paraphrase, some of the questions. They can be a little wordy, but let's start a really good question from Ben, in fact. He says, and he's given me some great feedback on the podcast, which I always love to receive, so appreciate that. Thanks so much, Ben. Anyway, he asks, as you mentioned in your previous podcast, self-managed super fund property investment offers some great advantages, including no capital gains tax at pension phase and a potential land tax reduction in New South Wales. In fact, I think most states tax a self-managed super fund as a separate entity without applying the higher tax rates that apply to trusts. So yeah, there's potential land tax savings, not only in New South Wales, but others. But he goes on to say, but has some disadvantage such as higher borrowing costs, and we have to set up a self-managed super fund, which we currently don't have. Our super investments are with an industry fund and a retail fund at the moment. We have about $2 million in super, in shares and ETFs, and all our investment properties are outside of super. Does it make sense to divest of some of the investment into a self-managed super fund, or do we continue to build the property portfolio outside super? My current feeling is it doesn't make sense to buy property inside super if we don't borrow, as shares offer a similar return, if not higher, to into property. I agree with that. However, the borrowing costs inside super are really high. Then it makes no sense for us to purchase a property without a mortgage inside super, especially since we have to sell some of our super assets to make the purchase, which will incur capital gains tax now. Would be great to get some advice from you on this topic. Ben, it's a wonderful question, and it's a really important question because I have noticed there's more businesses out there trying to encourage people to invest their super in property using some borrowings. And I think the answer is it doesn't suit most people. Now, full disclosure here, I own a property inside super with some borrowings. So I'm about to tell you not to do it, and I've done it myself, which I'll explain in a second. So a lot of people are attracted to using some of their super and borrowings to invest in property inside super because of avoiding the capital gains tax in pension phase. And it is a really attractive thing. Yes, I get that. The downside to the borrowing rates are much higher. I mean, there's a little bit more competition there now. They have come down a little bit, but I think I'm paying sort of 7.5%. So it's not, it's not cheap. It's probably 0.5%. Maybe I'm paying 7.5. Maybe it's 0.5% more or 0.5 to 1% more than what the loan would cost outside super. The big thing though is the negative gearing. Remember, if we have borrowings inside super, we're making the interest tax deductible, but only at a rate of 15% because that's the tax rate in accumulation. One of the benefits that defrays a lot of the holding costs of property is the negative gearing benefits we get from property outside super. And so whilst we might save capital gains tax in 20 years when we sell the property, over the next 20 years we're getting a lot less tax benefits inside super than what we would outside super. The other problem is because property is a liquid asset, of course, and because we're going to benefit from compounding capital growth, what will happen is, or what could happen with a lot of people is you end up having a self-managed super fund where 80% of the wealth in that fund is trapped inside this property, which means you don't then have a necessarily enough cash flow to pay pensions from that super, convert it into pension phase and pay pensions. And so in that scenario, you're forced to sell the property, but you might not want to sell the property and you might have a lot of wealth outside of super. You don't really want to sell any assets at that particular time. So I like the idea of property outside super, shares inside super. If you want to diversify across property and shares, I think most people benefit from that. They're the two perfect environments to hold those two assets. The property outside super, you've got more control over the property. You're going to get the negative gearing tax benefits. Yes, you'll pay capital gains tax, but it's only 23.5% of the gain. That's essentially what it's going to end up being with the 50% tax discount or less than that. It's considerable, but you get to keep 75% more than 3/4 of the capital gain as a result. So we shouldn't be too blindsided by that. And you don't have to pay it for a very long period of time, arguably, when you sell the investment property. When would I borrow to buy a property inside super? I would do that when it doesn't give rise to too much concentration into property. So for example, if I had a lot of shares in and outside super, or also inside super, and then I'm going to buy the property inside super, notionally myself, I would like to have almost 50-50 split between property and shares, or 60-40, something like that. I certainly don't want to be 80% into property because that's too illiquid and I'm not getting enough predictable income from that asset. I'm getting capital growth, that's great, but I need income in retirement or some liquidity in retirement. So that's when I wouldn't do it. And that's why I've done it in my scenario. I've got a lot of money invested in shares and also the property that I've purchased. I've got some plans for that asset. I'm going to hold it for 10 years, but probably not longer as well. So it sort of suited my circumstances, but it's rare. It's rare, and I would encourage you to keep investing in property outside and keep all your super into shares. That's a great question, Ben, and I thought it was really worthwhile spending a bit of time answering that for other people just to not get tricked into doing something like that, because I don't think it suits most people. Let's include another question. I'm conscious of time. I don't like to make these episodes too much longer than half an hour, but I've got a question from Brad giving me some great feedback on the podcast. Again, thanks so much, Brad. Anyway, Brad asks, I have a super balance of just below 500,000 whilst my wife has a balance around 50. I'm considering splitting my super into her account based on her unused concessional cap from the past 5 years. Before I do this, is there anything I need to be wary of or need to make sure I outline before I make the submission so that I end up with a tax bill in the end? Thanks, Brad. Great question. There's two elements quickly to clarify for people listening in this question. The first one is contribution splitting. Spouses and de facto can split concessional contributions in any way 1 year, 85% of that concessional contribution amount, because obviously you've paid the 15% tax, which means that I can contribute $10,000 into my super. I'll pay $1,500 in tax, 15%, and then the $8,500 I can move into my wife's account. The second element to this question is catch-up contributions. So I can go back to 5 years. If I haven't fully utilised the non-concessional cap, then I can do that. That used to be $27,500, used to be $25,000, then $27,500. This financial year, it's $30,000 per person, the concessional cap. So there's the sort of two elements to this question. And the question's really about equalising super balances. Is there any downside? Well, if you're going to make the contributions anyway, whether it's into your account or into her account, they're obviously locked away inside super. You've obviously made the decision to do that. That's fine. You've got to consider, whether that's the right thing for you. Let's assume it is, because your question's really about contribution splitting. Then the second thing to think about is, why would you do it? Well, the reason we would want spouses to have relatively similar super balances is it gives them the greatest opportunity to remain below what's called the transfer balance cap, which is $1.9 million, which is the amount that you can have inside pension and not attract any tax. So you can have up to $1.9 million per person, pay no tax in retirement, either on investment earnings or the pension. The issue is, of course, the government might turn around and decide to reduce that cap. So whilst you might have $500,000 today and be nowhere near that 1.9, it might reduce in the future. I mean, I think they'll be conservative about reducing it, by the way. I don't think it's going to, they'll halve it or anything like that. You said you got $500,000. I don't know your age. So you've got to work out, is there a risk that you're going to breach that cap? And if there is, then certainly you want a contribution split and try and even up balances. In your question, you said you would use her unused concessional caps. Well, if you're using her unused concessional caps, then obviously you've got to make the contribution into her super. That's not really splitting, but it's good to utilize those catch-up contributions, assuming she's got taxable income, because they're tax-deductible contributions. So if her average tax rate is above 15%, then making those concessional contributions is a good idea. But you don't want to bring her taxable income below 15%, because then you'll be worse off, because you're paying a flat 15% on those catch-up contributions anyway. The only other way to even up super balances is when you are in retirement or start the pension. It's called a recontribution strategy. And so what could happen is you put your balance into pension phase. You can then take out whatever you want, assume you're permanently retired. Let's say $360,000, because that's 3 times the non-concessional cap. So you withdraw $360 from your account, and then your wife contributes $360 into her account. And you can do that every 3 years using the non-concessional caps. And that's a way to sort of rebalance super over time. So if you can do it during the accumulation phase, that's good. And then you've also got another opportunity potentially in that retirement phase. But the key thing is just making sure both balances are going to be less than $1.9 million, or putting it differently, if you think you're going to end up with $3.8 million in super, you certainly want to make sure it's spread across 2 accounts. Great question, Brad, and thanks so much for submitting it. Look forward to receiving other people's questions. I said I'll get through them, and until next week, bye for now.